Everyone, welcome back to the market update featuring by Rationale and Marketsall. This week we've got a lot to unpack. Actually, the markets are buzzing with key developments from like latest CPI data, and alongside PPI data came in, retail sales data came in last week. There are a shift in inflation expectations after the election, and Fed's Powell had a commentary on rate cuts. Plus, NVIDIA is set to report earnings this week, and it could be a game changer for the market's direction after last week's sell-off. We'll also dive into how major sectors are responding post-election and what rising break-even inflation rate break-even inflation is telling us about long-term expectation. It's a lot of stuff to unpack. And let's start with the sector diversification after the election. Let's break it all down. First of all, let's closer look at this slide, this table showing month-to-date sector performance. What we see here can be largely attributed to the current Republican agenda. For instance, when you look at this table, you see that financial perform month-to-date 6.3%. For instance, why are financials performing so well? So Republicans often advocate for reducing regulatory burdens on businesses, particularly financial institutions. By easing compliance requirements, banks gain operational flexibility and lower costs. This environment supports profitability, encourage lending, and promotes risk-taking. Key factors that key factors that investors generally welcome. Another cornerstone of Republican policies is the focus on low corporate taxes, similar to what we saw with tax cuts and job acts of 2017. This pro-growth economic policies further fuel optimism in the markets, and we saw as a result of this mentality in the financial sector. And also Republicans' emphasis on reducing corporate and investment taxes also stimulates expectation on capital market activities such as merger and acquisitions, IPOs. This mentality aligns with the risk-on sentiment we're witnessing since the election, as markets often while I'm recording with you, last 2 days we saw beginning of this week and the end of last week, there was a sell-off in the S&P, but the sentiment was risk-on after the election. That's why I'm mentioning this, and this aligns with the risk-on sentiment. All market activities, potential IPOs, aligns with risk-on sentiment we're witnessing, as markets often associate Republican victories with pro-business environment. That's why cyclical sectors like financials tend to perform well under these conditions. Now that we talked about a sector performance, in order you to evaluate such table here, let's take a look at sector classification based on the market tendencies. This classification will help us understand how different sectors behave in various economic and policy environments. That's crucial in that terms. As you can see from this sector classification table, sectors are divided into 3 risk profiles: defensive, cyclical, and high growth. Defensive is risk off, cyclical is depends, and high growth is risk on sectors. You can think of like that. Since the election, the market has leaned heavily towards risk on sectors, which have outperformed the rest, as you can see, as you saw in this previous sector. When you check, for example, underperforming sectors were materials, real estate, utilities, not, for example, not technology, right? Not consumer staples. Communication service. These are more tech lean stuff, and as you can see, they perform much better. So risk-on sectors, which are these includes cyclical sectors, financial, industrials, and energy, as well as high growth sectors like technology and consumer discretionary. So this outperformance reflects investor confidence in pro-business policy environment and expectations of economic expansion under the Republican agenda. Risk-on behavior is typically characterized by increased capital flow into sectors tied to macroeconomic growth and market volatility. Now, moving on the next slide, we see here CME FedWatch Tool displaying the probabilities of the Fed's next action. So here in this chart, you see that this bar is a month ago shows the probability of Fed's rate cut in December meeting, and as you can see, it's around like a 76%. And currently it's around like while I'm recording this video, it's around like 59%. What's notable here is like this shift, this meaningful shift in market expectation for rate cut. This isn't a massive change, okay, from like a 79% to 59%. It's not like, okay, they're changing mind, they're gonna be like hawkish and stop. It's not something like that. But it doesn't negate the likelihood of an upcoming rate cutting, but it doesn't hint a potential like a baby steps of a shift in sentiment. Last week, Jerome Powell's comments played like a key role in this sentiment actually, especially, I mean, it actually supported the market environment after Trump came in, and in his speech he stated that the economy is not sending any signals that it's needed to be in hurry to lower rates. And you know, after the election, the inflation expectations were rising, and on top of that, a comment came from Powell, and when you check rates were going higher, and that kind of impacted inflation expectations like positively as in terms of the chart numerical version. It's not like positive that inflation expectation going higher, as it increased the risk of inflation being sticky. So that cautious tone has impacted market expectations, and as reflected here, and we saw the shift here from 1 month ago to until now. While like a rate cuts are still anticipated, the market is tempering its certainty, which is something to keep an eye on the coming weeks, I believe. And now what you see here is last week we received US CPI data and some economic reports like CPI, like PPI and retail sales for October. The report when you look at the results, like the numbers, reports were largely like dovish, like reinforcing expectation for potential 25 basis point rate cut in December. However, like Powell's relatively hawkish speech shifted the sentiment, leading to sharp repricing of rate cut probabilities, as I mentioned in the previous slide. So here are the key highlights of data. On a monthly basis, both headline and core inflation have remained steady for the past 3 months at 0.2 and 0.3% respectively. On a yearly basis, headline inflation rose to 2.6%, as you can see in this chart, while core inflation held at steady, like at 3.3%, unchanged from September. Over half of the monthly headline inflation came from shelter side, and it was the main problematic part of the service side as well. And it seems like remains a persistent issue. That's also another considering, like something to consider, I believe. So breaking down core inflation into goods and services, good prices declined by 1% year over year, while services rose 4.8% year over year. But as you might remember, like there was a really important indicator that Fed was also taking care. Fed is also gives highly importance to it. Like it's a super core inflation, which is like core inflation excluding shelter, in order to see clear picture while waiting the lagged impact of rate cuts on on the real estate sector. It gives more clear picture by excluding shelter. The monthly figure came in 0.20%. It's lowest since July. It's a positive detail for the market sentiment though, as it gives some signs that inflation is not sticky, or I don't know. It's a bold word. Sticky word is like a bold word in these days. The yearly change was reported 4.3%. So in summary, what we see is the shelter component continues to be being a problem. The monthly improvement in super core inflation is positive sign. That's one negative, one positive. The data supported expectation for the rate cut in December, definitely, but Powell's speech shifted the focus. So data came, Powell spoke, and it kind of both each situation canceled out each other. He stated, as I mentioned, it's not the economy is not sending signals that we need to be in hurry to lower rates. Additionally, here I would like to show you here in this chart here. What you see is it's a US break-even inflation chart, and it is considered as inflation expectation. And while you're calculating the real yields, for example, you subtract from US 10-year yield the inflation expectation. So it just by this way you take out the inflation effect on yields, and only real yields comes into your head, and that's how you calculate that, and that's why. So yeah, this break-even inflation is important. As you can see, after the election, you can see that this a little a uptrend maybe has started, but yeah, I just want to show you while showing the current CPI number and a core CPI number. I think this reflects the market's broader adjustment to the evolving policy outlook. Yeah, and not policy outlook, but it's after Trump impact actually. It has risen sharply after the election. This increase in, I think it's a critical signal that we need to monitor at. Finally, yeah, I would like to talk about NVIDIA's upcoming earnings, a major event this week that would significantly impact the broader stock market. At this stage, but at this stage of a Q3 earnings, in general, S&P 500, I think we're coming to the end of the Q3 earnings season. The S&P 500 showing a bit mixed result. According to FactSet numbers, 91% of S&P 500 companies have already reported Q3 results, and out of this, a 75% beat EPS estimates, which is below 5-year average of 77%, but in line with the 10-year average. Both the number and a magnitude of positive earnings surprises are tracking below their 5-year averages. That makes me a bit being cautious on the risk on sentiment, but yeah, just keep in your mind that's it might be important data to know. The focus now shifts to NVIDIA, which played a decisive role in determining if a last week's sell-off or at the beginning of this week just a temporary correction or the first signal of a broader market downward movement. Why NVIDIA matters this quarter that much? First of all, NVIDIA's performance is closely tied to capital expenditures of its major customers such as Microsoft, Meta, Amazon, and Google. Okay, yeah. As much as capex, as those companies make much more capex investments, that would mean that they're gonna buy more from NVIDIA. So last quarter, these companies reported increased capex, which is a good sign for NVIDIA's earnings for sure. This is typically positive for NVIDIA. So simply, the more companies invest in infrastructure with capex, capital expenditures, the more hardware they're going to purchase from NVIDIA to power their AI and cloud initiatives. If the capex trend remains strong, it could support NVIDIA's guidance and act as a tailwind for the stock. And in conclusion, this earnings report isn't just about NVIDIA. It's a test for a market sentiment, actually. A strong performance and guidance could stabilize the market, while any sign of weakness might fuel concerns about a larger correction. Before closing the video, let me show you, by the way, before switching to some charts, I'm not gonna show that much this week, but let me also this for the NVIDIA chart that you see in the slide. This was one of the trade ideas that was given in Rationale Equities report. You can find the link just below the video alongside with Marketsall website. You can subscribe to the newsletter. And here you see that there's a symmetrical triangle chart pattern is breaking out. We see a small pullbacks to the 21-day moving average, which is this a black line, and earnings is here. Generally, we'll see what's going to happen if it is able to break out from this. Here, it would lead to breakout from this cup with handle-ish formation, and the symmetrical triangle chart pattern's price target was at 218. Yeah, we'll see. We might see in a earning gap as we saw earlier earning gaps, earnings here, for example, here. Yeah, we'll see. And before closing the video, let me show you a few major charts. Here, what you see is dollar index. That's how I'm following right now. This is a weekly chart. This chart is both bullish and bearish at the same time. If it breaks out, I will be following probably the price. I don't see any resistance up until 113 levels, and in the downside there's much more room, but that's how I'm following. I just wanted to show you. And Euro USD, it's more or less doing a sideways action in the weekly charts as well. And today, and since the beginning of this week, we saw that gold is back a bit. Considering the moving averages, it's just below a 50-day and 21-day. I'll be monitoring if we're gonna see a rejection from these short-term moving averages. My expectation to see some consolidation around this short-term moving average, while this 200-day moving average converges to the price. That's my expectation to see. That's why I expect not a big move on gold. If something happens, if any important crucial data comes, things change. But yeah, that's the case for now. And lastly, I would like to show you this crude oil chart. That's how I'm following in the weekly. It's broken down. Apart from geopolitical tensions, the supply and demand conditions still support bearish pricing for the oil. That's why since there's no way to guess or forecast any geopolitical tension as long as you don't have any insiders from governments. It's not possible. That's why my a bearish view still remains intact. And yeah, that's all I'm gonna talk about this week. I hope you find, we covered NVIDIA earnings, break-even inflation expectations, sector diversification in the US equity markets, which is pretty important to give you the risk sentiment. Yeah, I hope whatever you watched in this video helpful. And if you like whatever you see here, please subscribe to our channel. Plus, if you have any question, please you can just write as a comment. We will be glad to answer. And you can find the links of Marketsall website, is like a Marketsall brokerage website, and Rationale newsletter report. You can subscribe free to Rationale reports to receive like a weekly in your inbox trade ideas like this, like NVIDIA, for example, as I mentioned earlier. And that's all I'm going to talk about this week. I hope you have a really great week, and have a nice day. Bye.